Let's go ahead and get started. We have a great guest today. Uh, let's go ahead and get straight to it. You guys know what you came to see. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Today we have one of my favorite guests on, Alex Elder. He has a great origin story. He might tell it to you. Alex is probably, I will go ahead and say he's probably best known for his best-selling books, Come Into My Trading Room, and I'm blanking on his second, on the other one.
The New Trading for a Living.
The New Trading for a Living, which is the second edition, and just a great speaker. I always enjoy kind of having Alex on. We need to do it a little bit more often because he likes to talk about what's relevant and what's current, and I respect his opinion a lot, and it's going to be a good class. Alex.
Well, thank you. Thank you very much, Jeffrey. You use such a great introduction. I have to make sure to invite you to my funeral whenever that thing happens. So you've got to stand over that box and say, "Oh, he's a great guy. He is so much fun."
Yeah, I will. In 50 years, when you die, I will come to your funeral and I'll give a eulogy.
I said to my wife, my plan is to die at age 105 from a gunshot wound to the back of the head from a jealous husband. And she says, "What about me? What about me? What am I going to do?" I said, "Well, you're going to be a rich widow. You're going to find yourself a better husband, younger too." No. In any case. So I'm kind of organizing the whole event, and Jeffrey, you're certainly being listed. In any case, bad joke. Sorry about that. Thank you very much for inviting me here. It's always a pleasure. And my plan for today is to say a few words about the markets, about my approaches to the markets. We'll take a look at the current markets, and then we'll go from there. We'll see what's cooking. There are probably some stocks you want to take a look at. We should have a busy evening. First of all, in a nutshell, knowing how to use the software and knowing how to use the indicators and knowing how to create a trading system will not make you a successful trader. All of these things are very important, and most of us, myself included, we begin from those things. Oh, how long should my stochastic be? And how should I structure my RSI? Well, that is only at best 1/3 of an equation, at best. Because successful trading is based on 3 M's: mind, method, and money. Now, today, of course, we'll be talking mostly about the method, but I just want you to remember that the method is not the beginning and the end of everything. The method is only a part of your approach to the markets. Psychology is extremely important. And money, risk management is extremely important. I can give my trading system to any beginner, and I'll watch them lose money with it while I'm making money with it. Why? Because no risk control. So I don't think it's on our menu today, the risk control thing. But I just wanted to know that even though today we will mostly focus on market analysis, on indicators, there is a whole lot more of extremely important stuff, i.e. psychology and risk control. And at the risk of sounding self-serving, I would refer you to my book, The New Trading for a Living. As far as psychology is concerned, there's a whole bunch of very good books. Mark Douglas, who died, about a few months ago, maybe a year ago, Mark Douglas wrote very good books, Trading in the Zone and The Disciplined Trader. There is a guy whom I never met, Brett Steenbarger, but he's a psychologist, PhD, and I've read one or two of his books. He's a very intelligent guy when it comes to psychology of trading. So there is a good literature, and there are good people writing and talking about psychology. As far as risk management, I'm afraid ain't nothing there, unless you read the New Trading for a Living. There is a book called The Mathematics of Risk Control, something like that, by a gentleman named Ralph Vince, or Portfolio Management Formulas, Ralph Vince. You've got to have an advanced degree in mathematics to read that book. Very, very, very hard. In any case, of course, I try to make it accessible in my own book. And I'm just mentioning it to you, not to push the book, although of course I wouldn't mind if you go and buy it, but not to push the book, but simply to say that what we will talk about today is only one of three key aspects of trading: psychology, mind, method, money. Psychology, method analysis, and risk control. So having said that, let's move on and talk about the method, which is only 1/3 of your success, but that's what we're going to do, since our hosts, our generous hosts today are Metastock, and they do software that helps us analyze the markets. Jeffrey, if you don't mind, could you possibly compress this chart on the screen, zoom way out, so we would go back, so that we would go back, let's say, to, oh yeah, that's it, perfecto, perfecto. Okay, great. So what you're looking at here is the history of the Dow Jones Industrials, starting in 2006 and to today. And I would like to begin by saying that whenever you analyze the markets, you have to make your strategic decision on a long-term chart and tactical decision on a short-term chart. So many people trade with a single time frame. They look at the daily chart, or they'll put up a 10-minute chart, whatever they like. And occasionally, more often than I like to see them, I get emails from these people who are sending me the chart and saying, well, what do you think about it? I think nothing about it. I think absolutely nothing about it, because I refuse to analyze charts in a single time frame. To me, analyzing single time frame, it's like driving with one eye closed. Can it be done? Yes, it can be done. Should it be done? No, it shouldn't be done. So this is the weekly chart, very long term, and we look at it and we see what's the big deal, what's the big trend in the markets. We're going to analyze it on the long term chart and make a strategic decision. I will make a strategic decision for myself. Am I a bull or am I a bear? And then I will switch from the weekly to the daily chart, and that's where I will decide how to implement my strategic decision. So first of all, take a look at a very long-term chart. Here we're looking at a 10-year history, and you can see this wonderful top on the left that formed in 2007, 2006, 2007. A bunch of divergence is there. A horrendous bear market that brought the world financial system to the brink of collapse, and that bottomed out in on March 9th of 2019. And by the way, take a look at this pattern, which you can see on this chart. Look at the bottom in 2008. And how deep a MACD histogram was. Then there was a rally above the zero line. I call this breaking the back of the bear. And then Mr. Bear drove the Dow now down to a new low. And look at the depth of a MACD histogram at the new low. Look at the depth of a MACD lines at the new low. And look at the depth of force index, the indicator I invented, at the new low. So we have a trifecta, a triple bullish divergence. Bullish divergence of MACD histogram, MACD lines, and force index. So on the surface, which is of course what 99% of people look at, the surface. On the surface, everything is horrible, and the market is going to a very bad place in a handbasket. But if you look deeper and look at technical indicators, you see there's a wonderful bullish divergence. Prices are lower, but the indicators show that that bear is weak, and that was the bottom. That was the bottom and the beginning of a fantastic, huge, 5-year-old, incredible length, 5-year-old bull market. Now, we understand now that it was the Federal Reserve pumping money into the economy that kept the bull market going for so long, but it kept on going. And by the way, even here on this very long-term chart, you can begin to notice a certain pattern. You put an envelope on the chart, and this envelope we're looking at here is something that I developed with the help of my genius programmer, John Bruns in Chicago. It's called auto envelope, and you can see how it's sort of like a sausage. The market comes up to the upper end of the envelope, and it's a sell. It comes to the bottom line of the envelope, and it's a buy. And so every few months there is a panic, there is a great buying opportunity, and then a rally to overbought zone. In any case, this game was going on into 2015. In 2015, the market has gone flat. Every little upside breakout was just very... Jeffrey, maybe we can zoom in a little bit. We no longer need this ancient history, just so we have a... Okay, great. Perfect. That's it. Let's stop here. So this is 2000. The left side of the chart is 2015, and you see this last 3 attempts at a rally. Each of them has a very minor upside breakout, which chokes up a week later and comes back to value. Another breakout chokes up and back to value, and then there's a nasty break in August, September of last year. A pullback, and then even nastier break in January, December. And that's it. So the bull market that began in 2009 ended in May 2015, and it was followed by a very short and a very brief and a sort of shallow bear market. And that's an important feature of the markets. History rhymes, but it doesn't repeat. We had a horrendous bear market in 2008. We had a garden variety bear market in 2015, 2016. That bear market ended. You can recognize, I hope you can recognize, a very valuable pattern at the right, during that bottom. You see this single bars sticking out of a tight weave of prices. I call them kangaroo tails, or it was actually my translator in Moscow, the woman who translated my book from English into Russian, who came up with the name kangaroo tails. I used to call them fingers. And these kangaroo tails very often mark important reversals. So again, a set of kangaroo tails, a bullish divergence of MACD histogram, a bullish divergence of MACD lines, and that was January, February of this year, ladies and gentlemen. That was the end of a brief bear market. And we are now in a bull market, where the new bull market has begun, and we're in the third rally of the bull market. The first rally began from the lower channel line and went to the upper channel line, and then there was a couple of months pause going nowhere. There was a deep stab down, and that was Brexit in the UK. When the Brits decided to leave the European Union, you know, the politicos in Brussels were telling the Brits, just one of many examples, that they could not eat bananas to which they were used to, because those bananas did not correspond to European standards. They had to import different bananas. Can you imagine? A bunch of countries, most of whom were just communist dictatorships 20, 30 years ago have an equal vote with the UK and telling them what to do. It's charming. In any case, the Brits voted to leave, and the market dropped for 2 days. And after that, a very powerful rally began, and again, up to the upper channel line. Then again, a couple of months of going nowhere. Prior to the election, there was a brief false downside breakout, and the day before the election, the rally began, which continues to this very day. So we had one powerful rally in February, second rally post-Brexit, and the third rally is going on now. Whoever you voted for, whoever you like or don't like, one thing is without a doubt that the guy coming into the White House in just about a month is the most pro-business president in a generation. And he is promising all kinds of good things for business, and that's what's driving this, the latest rally in the bull market. Is it going to go straight up? No, it never goes straight up. It's going to have its own pullbacks and everything. But the business fundamentals are changing, and they're changing for better for the business. And so there's a major bullish fundamental factor, and prices are responding. Now, in the short run, prices are, of course, completely overbought. And you can see how this last weekly bar this week has penetrated above the upper channel line. And this is massive splash of bullishness. This is something that we have to go back several years to see it. Jeffrey, maybe let's compress the screen a little bit, just to, I don't even recall, when was the last time? I think we can see it here. It was 2013, yeah? You have to go back 3 years to see something like what's happening today, when prices blew out of the channel. And then there was a pullback to value, and then the bull market continued. So let's zoom in again and see the bigger chart. So looking at this chart, I can say, without looking too hard over my shoulder, that the United States stock market is in a bull market. This bull market is overbought, which there's no law that says if it's overbought it has to reverse. It's overbought. It can stay overbought for a very long time, but it's overbought. So it's bullish, and at some point in the future, it will pull back to value and give us another buying opportunity. So that's my view of looking at this chart. And so looking at this chart, I would say strategically, I have to be a bull. I have to be much more comfortable buying, but it's not the best time to buy now. The best time to buy was around the election time. Right now, the market is overbought. We have to be much more selective. And there actually may be some shorting opportunities, because when this thing starts pulling back to value, there will be quite a bit of a move. Just before we go any further, Jeffrey, if you don't mind, let's take a quick look at the weekly chart of the NASDAQ and then later S&P. So we're looking at the industrials, which is the narrowest of indices. Let's take a look at the NASDAQ at a very broad index. All right. And while you're pulling it up, there's a very clever question. Will you compare charts of Dow Jones, S&P, Russell, and NASDAQ? Good question, M. Randall. Very good question. There was a question from Harry who was asking what a kangaroo tails. A kangaroo tail is a tall bar surrounded by narrow bars. Look at this. Look at this chart of the NASDAQ, right smack in the middle. The stock market starts collapsing, and it throws a very tall bar down. The next bar is flat, and you have the single long bar sticking out of a tight weave of prices. That's a kangaroo tail for you. One of the most reliable formations in the bull market. In any case, here we're looking at the weekly chart of the Nasdaq. It's not anywhere near as strong as the Dow. It's not anywhere near as strong as the Dow. It rallied post-election, but the rally wasn't all that exciting. It did not even take its previous high for this year. So it's less bullish than the Dow, which is actually not a very good sign, because there is a brilliant market analyst and money manager in New York, a gentleman by the name of Gerald Appel. He is the guy who invented MACD lines, an indicator many of us use, and he did research that showed that when the Nasdaq outperforms the Dow, it's bullish for the entire market, including the Dow, and when Nasdaq underperforms the Dow, it's bearish for the entire market, including the Dow. So the Nasdaq is definitely underperforming. Let's take a look at the chart of the weekly chart again of the S&P. Okay. So the S&P is not as strong, is stronger than the Nasdaq, but not as strong as the Dow. So conclusion: the bulk of the money in this rally is going into Dow-type stocks, big stock, big corporate stocks. Why? Well, because the new administration is coming in, and people don't really know what to expect, and so they're going into quote-unquote safe stocks. I once met a guy at a conference who said he had a general theory of investing, which meant that he only bought stocks which had a word general in them. General Motors, General Electric, etc., etc. So this is the general theory of investing for you. Money is going into big name stocks, and much more cautious about smaller numbers. An indication perhaps that a pullback is coming sooner rather than later. So this is my view strategically. We're in a bull market. Bull market is overbought. Buying is perfectly fine, but we have to be selective. You don't, I mean, I don't know what, I don't want to buy new highs. I just, I choke up on new highs, on buying new highs. I want to buy value. I want to buy cheap. I don't want to buy blue sky stocks that are streaking into the new high ground. Why? Personal, completely personal decision. There are good traders who buy breakouts, and there are people who buy pullbacks. Well, I buy pullbacks. Buying breakouts, I just, why would I want to pay $120 for something that was $80 2 weeks ago? I can do without. I don't have to buy it. So let's take a look now. Let's take a look at the daily charts. Let's go to the daily chart of the Dow, followed by the Nasdaq, followed by the S&P. Someone is asking, well, while you're pulling up the data, Jeffrey, somebody is asking a question about looking at ETFs. I dislike ETFs. I generally dislike ETFs. I mean, occasionally on a blue moon, I may trade something like SPY or QQQ, but other than that, other than those absolutely super major ETFs, I avoid trading ETFs because they're not free. They cost money to trade, much more so than individual stocks. And so if I have an opinion, I'll trade it. I'll trade index futures all the time, and I trade individual stocks. But ETFs, you're paying for the convenience. ETFs, all ETFs gives you a quote-unquote a haircut. Now, with a super major ETF like SPY, that haircut may be a small fraction of 1%. But if you go into more exotic ETFs, a haircut could easily be 4, 5, 6%. Well, 4, 5, 6% makes winning essentially impossible, in my humble or not so humble opinion. So I'm no friend of ETFs, I'm afraid. So here we're looking at the daily chart, of the Dow. A super powerful rally began on the day before the election. And Jeffrey, actually, if you could draw a line across the September lows extending forward. Yeah, a little higher. No, September lows. Yeah, that's it. Okay. What you're seeing here on this chart, to my way of thinking, is one of the most attractive trading situations in technical analysis, a false breakout. You can see how in October the Dow broke below support, and it didn't like it there. It was back before the day was out. And you can see what happened before the election. The market was driven to a new post-Brexit low, but look at those tiny nothing little bars. It really shows no enthusiasm going there. And then on Monday before the election, the rally began. And as soon as prices closed above the breakout line, that was it. That was a buy signal, and a very good one too. Now, the Dow rallied above the upper channel line, pulled back a bit. Yesterday had this fantastic, crazy rally. And by the way, what we're seeing at the bottom of the chart, MACD histogram, it is not a divergence, not a divergence. In order for a pattern to be classified as a divergence, we have to have a crossover of the central line. And there's no crossover. It's just a rally that is becoming older, not as strong as it was a month ago, but it is not a divergence because MACD histogram never crossed the zero line. Maybe a quick look at the Nasdaq daily, and then S&P. Well, somebody forgot to send Nasdaq a letter that there is a bull market going on. Right? Nasdaq had a powerful post-Brexit rally, and now just flat as a pancake. Not the happiest picture from Mr. Bull. Let's take a look at the S&P. Well, similar picture to the Dow. Broke out above the upper channel line, very overbought. I refuse to buy above the upper channel line. I mean, markets are manic depressive. Above the upper channel line, this patient is having a manic episode. Below the lower channel line, this patient is depressed. So somebody said a long time ago, a neurotic builds castles in the clouds, a psychotic lives in those castles, and psychiatrist is the fellow who collects the rent. Well, I want to be paid. I want to collect money from market's craziness. I don't want to run with the craziness. And what's happening at the right edge of the chart is crazy. The market is crazy, manic, overbought. Wonderful, pleasure to look at, but not to buy, not for me. So I'm sure that later today, we're about halfway through our webinar. Later today, as we look at individual stocks, we very well may find some stocks which offer us buying opportunities. But the indices, nah, way too high, way too high. So I'm taking a quick look into the room, and I see there are several people asking about gold. Well, let's take a look at gold. Let's pull up a weekly chart of gold. Remember, I refuse to look at the daily chart before I look at the weekly, because if you and I've seen so many people, they look at the daily chart and then say, oh, you know, Elder says should take a look at the weekly. Oh, too late, because if you began with the daily, your eye is already prejudiced. You have to start with the weekly chart. You have to start with a strategic decision, and then go to the tactical one. So Let's compress this chart again, Jeffrey, if you don't mind. Now go 10 years back or so. Okay, well, something like this. Yeah, perfect, 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 perfect. So maybe we'll open it up a bit. Click the up arrow once. So this is a chart of gold. Gold traded below $1,000 always, forever, and I remember very well back in 2008, 2009, I was speaking at all these conferences and saying, once gold breaks out above $1,000 an ounce, there is no going back. It's building up for a breakout, and so the breakout happened, and gold shot up to $1,900 or approximately $1,900 an ounce, and that's where everybody got happy and bullish. You know, there is a book that says buy low, sell high. It's a strange thought because most people like to sell low and buy high. Buying high feels very comfortable because you have plenty of company, but it's not the best thing to do. So gold topped out at 1900. It began a bear market, but notice this bear market never came below 1,000. At the very end of last year, beginning of this year, gold came to approximately $1,050. Let's zoom in again now. It had a beautiful, thanks. It had a beautiful run up from about 1050 to about 1350, 1370. And what's happening at the right edge of the screen? Well, I would call this a pullback in a young bull market. The bull market began, and by the way, you can see beautiful bullish divergence in the middle of this chart as the bottom of the bear market was being formed. What we're seeing here is a pullback in a bull market. Notice gold's behavior. If you pay attention to the last 5-6 weeks, you can see this very tall bar on the way down. Well, that was real bearish, and after that, a short bar, a middling bar, a middling bar, and a short bar now. So basically, there is not much enthusiasm in shorting gold. That enthusiasm ran out 5 weeks ago. And at the very right edge, MACD histogram has ticked up, which is bullish. And you can see that prices are really finding support at the lower channel line. So looking at this chart, I would say count me as a cautious bull on gold. Why cautious? Well, because I'm not sure that this is the bottom. I think gold is definitely in the bottoming area, but whether this is the bottom, we'd have to look a little more closely. So strategically, I'm a bull, and for tactics, let's take a look at the daily chart. So, I don't think bottom building is finished yet. I don't think it's finished. Why not? We usually see some kind of bullish divergence at the bottom. There was no bullish divergence on the weekly chart. This is not really a divergence. We have lower prices, and we have a MACD histogram, which is the same depth, and we see MACD lines which are deeper now than they were back in October. I think the bottom is being built, but I don't think it is in place yet. Perhaps a rally towards 1200 and then a pullback. I think bottoming work is just simply not finished. If somebody said to me, you've got to put in a trade in gold and get out of town, come back in a week, I would sell it short. If somebody said to me, you have to make a trade in gold, get out of town, and come back in the middle of 2017, I would buy it, and I would buy a lot. So short term, it looks heavy. Longer term, it looks very constructive. Now, how do you know that I am right or I am wrong? So if you want to check, you should write down what I'm saying, right? Alex Elder said, short-term gold looks heavy, long-term it's building an important bottom, expect higher prices ahead. Well, will you check it a month from now, 2 months from now, 3 months from now? You should. One of the, correction, not one of the most important thing you can do for your growth and development as a trader is keep good records. You should keep good records on yourself. You should have a diary for every entry and every exit. And then if you hear somebody's opinion and you decide to play that opinion, well, you ought to write down whose opinion you are listening to. Because some people are very bright and they give horrible opinions. And some people maybe not so bright and they give wonderful opinions. So, but you won't know until you start keeping records. You should. So, is that a bear divergence between March and July? Is the question. March and July of Ray is asking this question. Weekly or daily chart? Please clarify. Anthony is asking, will there be a recording of this webinar? Jeffrey, I believe there will be a recording, and you will be able to.
I can agree with you.
Yeah. So let's go to the weekly chart of gold. Let's go to the weekly chart of gold. Ray just answered the question. And zoom in a little bit, kind of open it up a bit. So the question was, is that a bear divergence between March and July? Yeah, sort of, a bit. Yeah, not, you know, for a divergence to be really nasty and for me to say, oh, I'm going to trade this divergence, I want that break below the central line to be deep. I want Mr. Bear to come in and show his claws. This was a pretty shallow picture here. I saw it. I was not shorting gold at the time. It just, you know, the divergence was too feeble. But it is a divergence, no question about that. Just not the best one. Jim is asking, do you find any value in applying technical analysis to consumable commodities like oil and natural gas, heavily influenced by politics and fear? I mean, I day trade crude oil and based on technical analysis. Longer term, I think, longer term you have to have fundamentals. But for the short run, I mean, if you're going to buy something at 9 o'clock in the morning and sell it at 10:30, you know, fundamentals are not going to be very helpful. It's all technical. But for the longer term, definitely fundamentals. But you know, all commodities are consumable. I mean, what about wheat? What about corn? I mean, we don't just look at them, right? We eat those things. So, you know, technical analysis is very applicable to futures. So, and it's funny how the questions are coming in and all about ETFs. Scratch ETFs, trade the real thing, You know, some ETFs just refuse to touch, like for example, commodity ETFs. I mean, those things are beyond crooked. I mean, they're horrendous. I stopped trading oil ETFs on the day when I had gold futures and they went up and gold ETF went down. So that's it. No more gold ETF for this camper. Someone is asking me about selling put options on gold. You know, selling options is a very, very intelligent game. There is basically, when it comes to options, there is a dumb game and there is a smart game. The dumb game is to buy those things. I have met thousands and thousands of traders and investors. I never once in my life went somebody who made money buying options. Now, everybody has a happy story buying options. You know, you buy it for $2, you sell it for $8. Everybody has a happy story like that. But over a period of time, buying options is a losing game. Selling options is a very winnable game. I don't do it. I simply don't do it because they're unfortunately only 24 hours in a day, and I trade different styles and I trade different markets. But I have a number of friends who are making a good living year in and year out selling options, writing options. So I appreciate your question that you're looking to write an option as opposed to you would rather sell a put than buy a call, which is very smart. But I cannot comment on the quality of the idea simply because I'm not an options person. Melanie is asking to look at CIM. I don't even recognize the symbol, but Jeffrey, let's pull it up. And Melanie, please watch. Opening a weekly chart. I'm not allowed to look at the daily until I look at the weekly chart and make a strategic decision there. So thanks. That's wow. You know, there is value. No, compress it again, Jeffrey. Compress it again. You know, there is really great value to this down arrow key on your keyboard. You keep pushing that key until you get 10 years of history inside. And the CIM, Chimera Investing, look at this. It looked like it wasn't some kind of trading range before. But now that Jeffrey compressed the whole thing, we see that this baby traded for $90 a share. So where it is now, it's hugely cheap, right? Good to know. Let's zoom into the right edge now and see what it tells us there. A little bit more. That's it. Thank you. Perfect. So we see that this Chimera had a nasty break in January. A kangaroo tail, you see it, yeah? And then from January, it rallied all the way into August, completely ignoring the Brexit. I don't know why, but it did. There was a pullback into the value zone in September, October, and now there is a powerful rally going on. Now, so it's rallying to the right edge of the chart. The moving average is rising, and the MACD histogram is rising. And Jeffrey, I'm sure you can, we don't have to do it now, but I'm sure you have it in that toolbox. You can use the impulse system to color the bars. And so, if you do, of course, the rightmost bar is going to be green. I apply the impulse system to all the markets that I analyze, and it's the system that I invented years ago, and when I go to trade shows and whatnot, I see clowns who take the system and use it as a trading system. Buy green, sell red. Well, yeah, buy green, sell red. Good luck to you, man. It's not a trading system. It's a censorship system. It doesn't tell you what to do. It tells you what you are not allowed to do. What I want to do with this stock, I see that it's trying to build a powerful bearish divergence. Look at the power of MACD histogram in April, May, June. Mr. Bull was extremely strong. Then in September, October, there is a break below the central line, breaking the back of the bull. And now Mr. Bull is back again. But it's not really a very strong bull, isn't it? Compare the height of MACD histogram now to the height of MACD histogram in summer, May, June, July. Right? So the stock or this fund is building a massive bearish divergence. And what I want to do is sell it short. And the impulse system says, Alex, you can want all you want, but you ain't getting any. You are prohibited from selling it short. You are prohibited from selling it short because the impulse system is green. You're allowed to buy. You don't want to buy? Your business, don't have to do it. But you are prohibited from shorting. The impulse system applies two parameters, or correction. The impulse system looks at any ticker in any time frame from two angles. What's the inertia? Well, the inertia is defined by a fast-moving average. And there is no question here that the fast-moving average is rising. Inertia is up. The second question is, what's the power? What's the direction of power in the market? And direction of power is dictated by a MACD histogram. A MACD histogram is rising. So the impulse system is green. I am not allowed to sell short. So I have enough of my own candidates, so I don't think I'll be tracking this particular one. But if I did, I would print out this chart, put it on the wall, and mark in red at the right edge, sell short when the impulse system stops being green. You see what I mean? It's a bullish market. I mean, if somebody held a gun to my head and said, Alex, got to trade it tomorrow morning, buy. Do I want to buy it? Nah, too expensive. Too expensive for me. I'd rather wait for a shorting opportunity, for the bearish diversions to push it down. But I'm not allowed to short it now, so let's watch it. Let's watch it. Good luck. Interesting stock. Not for today, but interesting stock. Bruce is asking, do you trade Forex? I very much do, but I trade it in only one way. I trade Forex futures. I think Forex houses are very suspect. Very, very suspect. This gentleman says my biggest losers this year SYNA, that's China, I guess, and PNRA. You know, we all have losing trades, myself included. You can't make money on every market, in every market, in every trade. So taking losses is part of the game. And I'll just make a couple of comments about losses. First of all, every stock, correction. First of all, every trade, never mind whether it's a stock or a future, deserves three numbers: entry, target, and stop. If I began showing you my open positions, you would see that there is an arrow at the point where I either bought or sold short, and then there are three numbers: entry, target, stop. Entry, target, stop. Without those numbers, it's not a trade, it's a gamble. So when you put on a trade, you have to decide in advance what is the biggest amount you can lose on this thing. Now, it could be worse. It could gap across your stop and everything. But nevertheless, a bad defense or a deficient, not bad, a deficient defense is better than no defense at all. And so you have to have those three numbers. And second of all, I find it's very counterproductive to focus on every trade. Am I making money in this trade? Am I losing money in this trade? There is quite a bit of randomness in the markets. And any individual trade has a fair bit of randomness. And so I focus on being profitable at the end of the month. During the months, up and down and this and that, but I want to be profitable at the end of the month. That's my time frame. For somebody else, it may be a quarter or a year. For somebody else, it may be a day. Depends on your time orientation. But for me, I want to be profitable at the end of the month. And if you do it that way, you really stop worrying so much about individual trades. Makes your life just so much more peaceful. Take a look, Jeffrey. Let's take a look at this ticker. We're being asked CCJ. I think it's a uranium stock, if memory serves right. I could be wrong, but the high was $55. It's trading now at $10. With the change of administration coming in, you would think that uranium certainly looks a lot less like a doghouse property than it did just a few weeks ago. And let's zoom into the right edge. uh, you can see just this very, very powerful rally. The impulse system is green. It's hitting the upper channel line. Let's take a look at the daily chart. Wow, 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 wow. I refuse chasing. I refuse chasing stocks like that. Now, there are people who do, and more power to them. I'm not saying it's wrong. It's just you have to decide what works for you or what doesn't. I refuse to buy above the upper channel line. It's definitely an attractive stock. It's a stock in a young bull market, and consider buying pullbacks to value. There will be a scare, there will be something, and it's going to decline towards its moving average on the daily chart. That's where I would buy. And by the way, Jeffrey, let's do this. Just let's pull up two numbers. You see this double bottom in the center of the chart in October, November? Let's look, what was the October low and what was the November low? The October low, I'm sorry, yeah, the October low was 745. And the November low, 741. 741 was the low. It's a lovely pattern. I mean, if you're doing scanning and if you want to write some kind of scan, this is the kind of thing you want to look at. This false breakouts. I mean, that's how major trends are often launched. Uptrends and downtrends. The market goes to the old low, takes it out by some kind of nothing little percentage, and then it's off to the races. This false breakouts really a very, very, very valuable pattern. I just happened to see it on the stock that I haven't looked at in months. Very well worth paying attention. There is a request. Let me just see. I just missed. Okay, let's pull up this number. How about this? CPB, Charlie Peter Boris. CPB. What is it? I don't even recognize the thing. Campbell Soup. All right. It's an expensive stock, right? We're looking at a 10-year history. It's trading closer to the top than to the bottom. But it's a consumer. It's a very well established. Let's zoom into the right edge. It's a very well established consumer stock, and it's doing very well. If we go back to this summer, look at this false breakouts. Right? The peak was established in March, April of this year. A breakout to a new high and collapse. Breakout to a new high in July and collapse again. So these false breakouts, you know, some stocks like certain patterns, and it just had a false downside breakout in October. Look how it kept taking its lows by a little nothing percentage. Now there is a reversal and the stock is very much on the way up. So strategic decision on the monthly, on the weekly chart. It's bullish. And it's not overvalued yet. It's not overvalued. It hasn't reached the upper channel line. We have a bullish stock. So strategic decision, let's get long. Now, down to the daily chart to look for a tactical thing. And by the way, let me just mention this. Please don't treat this as a pick of the month club. I cannot tell you what to buy or what to sell short, because I don't know you, I don't know your financial situation, I don't know your risk tolerance, none of those essential factors. So when I say about the stock, it's a buy, it's a short, it's not advice for you to act. I'm simply thinking out loud. I'm saying, if I trade this, how would I trade it? And that's what I'm sharing with you. So Campbell Soup, going up very nicely, and every once in a while it pulls back towards its moving average. How long is this EMA, Jeffrey? The blue one in the middle of the chart. 22. Let's add one more. Let's add a 13 bar EMA in addition to this one. Let's say and make it red. That's a serious menu. Oh, the color of the chart changed.
Oh, just for a minute.
The impulse system disappeared. Yeah.
So, oh, it'll be back.
All right.
It's just telling me that when I drop this moving average, it's going to be on price.
Yes.
Okay, and you wanted it red. Okay,
Yes.
I'm going to make it a little thicker so we can see it.
A person with a thicker skull needs a thicker line. That's for me. Okay. So this is how I like to look at it. It's actually too thick. Maybe make it a little thinner. Kind of too overpowering. So thank you very much, Jeffrey. Fantastic. What we see now is how I like to look at charts. Two moving averages. One is slow, the other is fast. And the space between those two moving averages, I call them the value zone. So what does Campbell Soup do? It spends most of its time levitating or steaming above the cup. But every once in a while, every few weeks, there's a bit of a panic, and Campbell Soup pulls into the value zone, and that's where you want to buy it. Buy in the value zone, take profits at the oversold area above the upper channel line. It's a simple but surprisingly effective trading approach. Buy value, sell above value. I mean, it's not like as if you're going to catch the lowest price for 10 years and then sell it at the top price for 10 years. But for a short-term swing trading, this is a very doable method. Buy in the value zone and offload, take profits above the upper channel line. Jeffrey, I'm afraid that we're going to put everybody to sleep here. It's past 7 o'clock, and I could go with something like this for hours, but I think it's we have to have mercy on people who have life outside of the markets and outside of trading. So let me just very briefly summarize what we talked about. To express everything in a nutshell, I want to say that successful trading is based on 3 M's: mind, method, money. Today we spoke mostly about the method, but that's not sufficient. You have to concentrate on trading psychology, and you have to concentrate a lot on how you manage risk in your account. How do you decide what size to trade? Whether to trade 100 shares or 300 shares. There are formulas for all of that, and if you don't know those formulas, you better read books that tell you what those formulas are. When it comes to technical analysis, which is what we spent most of our time doing today, there is less to market analysis that meets the eye. Look, we're only analyzing 5 pieces of data: open, high, low, close, and volume. So using 5, 10, 15 indicators, it's not going to. It's unnecessary. You don't need 10 indicators to analyze 5 pieces of data. And you can see that I limit my analysis to just a handful: a pair of moving averages, the impulse system, channel, MACD, histogram, and lines, forced index. That's pretty much it. Strategic decision on a long-term chart, tactical on a short-term chart. And the last thing I want to say to you, and that the single most important thing you can do for your growth and development as a trader: keep good records, keep a trading journal, keep a trading diary, write down why you have a chart for your entry and write down why you entered. Have a chart for your exit and write down why you exited it. So that's pretty much it in a nutshell. And Jeffrey, thank you very much again to you and to Metastack for inviting me to speak, giving me this public platform, because other than that, I just live in the middle of nowhere, forests and mountains, and I see more squirrels than I see people. So this is
You did not talk about Spike Trade. Do you want to talk about a little bit about what you do on Spike Trade?
Well, Spike Trade is a group of serious traders that I run together with my friend Kerry Lavorne, and we have traders who compete for the best trade of the week. We have we have regular members and we have elite level members, and elite level members participate in a cash bonus pool. It was almost $10,000 last quarter. It's not so big this quarter due to their performance, but it's real cash money for submitting the best picks of the week. And people share ideas. You can track those people live in real time, and every single night, Kerry and myself post our comments. We analyze markets. We tell you what we think is happening, where the market is going. It's an absolutely unique club, online club. A trial membership will set you back $29 for 2 weeks, and that's what I suggest any serious trader should do. Come, join the club, look at it for 2 weeks, and if you like it, you may stay with us forever. If you don't like it, you lost very little. Thank you very much, Jeffrey.
Thank you. Thank you. All right, I had to make sure my mic was on for a second there. All right, great. I do want to kind of give a little bit of a plug to Dr. Elder's add-on. It does contain all of the indicators and systems that he talks about in trading for a living and come into my trading room. As Jim said, he's been using it for apparently a really long time. He's using it with the Metastock 11, which would put him about 16 years ago. So it is one of my favorite add-ons. I'd recommend you get it. And it's also very, very value priced. I keep telling Dr. Elder that for what you get out of this, it's normally like $300, $299. With any of the other products that we sell, it's 100. Basically, it'll have a 30-day money-back guarantee. You're not going to return it. The offer for you here at the webinar is if you want to get it, we'll give it to you at really $199. And for those of you, most of you here are Metastock users, thanks for that. For the 40-something% of you that aren't, you can also get a Metastock trial as part of the offer. So you can pay $199. We'll give you a 30-day access to Metastock. Metastock has been rated for every single year. Since like 1992 or 1993, it's been rated #1. So then you can find out what you've been missing there too, if you want to try out Metastock. So $199, super cheap. You should get it. You should also read the books. And Dr. Elder, what a fantastic presentation. I want to say thank you for being here. Thanks for your time. Always an enjoyable discussion. So, with that being said, I want to thank everybody for coming. And as always, happy trading. We'll see you at the next event.